Buy at support, sell at resistance. This is a very common phrase in trading. Have you ever bought at support, thinking that it will hold and only to see it break down? Or perhaps you sold at resistance, only to see price break above? I'm sure it has happened to you. But hey, did you know that there are instances where you should not be buying at support and selling at resistance? Yes, getting stopped out when price breaks support or resistance is all part and parcel of trading. And while I can't help you eliminate this, I can show you how to reduce the likelihood of buying into a support or selling into a resistance that won't hold. This video will show you 3 scenarios where you should not buy at support or sell at resistance. I will also provide a couple examples to show you what I mean. And there's also a very specific news event which you want to avoid. And I will touch on this towards the end of this video, so make sure to watch this video till the end. Now, before I move on to the first scenario, do me a small favor by hitting that thumbs up button and subscribing to the channel. It helps support this channel and we can reach more traders like yourself. We also do a giveaway worth $37 for every single video that we upload. So if you wish to participate in our giveaway, then look for an emoji somewhere in this video. You can also find the full instructions in the pinned comments down below as well. So moving on to the first scenario where you want to avoid buying into support or selling into resistance. And that is the scenario where you have the higher time frame support and resistance. Suppose the price is parked at a higher time frame support level in the day 1 chart and you see resistance in the H4 chart. Should you go ahead to sell at resistance? Well, the logical answer is no. As a general rule of thumb, the higher time frame trumps the lower time frame. This rule applies to support and resistance as well as trend. Let me explain this further. So, if you see the daily time frame in a bullish trend and the H4 time frame in a bearish trend, then you should lean towards the daily bullish trend because it is more established as given by its duration. So the same concept applies to support and resistance. If you see higher time frame support coming in and a lower time frame resistance, then lean towards the higher time frame support and avoid selling at the lower time frame resistance. Let me show you another example quickly before giving you some guidelines about selecting your higher time frame. So right here we have price approaching support in the H4 chart. But if we were to go to the daily, you will notice that price is parked at an important key level. In this case, we should not buy at the support because the price is more likely to respect the stronger resistance level given by the daily chart. So hopefully this is clear and you got a concept of checking the higher time frame. Now, you're probably wondering, how do you select the right higher time frame? Should you go into the daily chart, the weekly chart, or perhaps the monthly chart? Well, I've covered this concept in a previous video before. I call it the rule of 4. I'll do a quick refresher in this video, but if you want more information on that, I will leave a link to that video at the top right and at the end of this video. So what the rule of 4 means is that the higher time frame chosen must be at least 4 times of the time frame that you are looking to trade at. Suppose you want to trade off the H1 chart. In this case, if you were to apply the rule of 4, then you should look at the H4 chart as your higher time frame. Now suppose you trade off the H4 chart instead, then you might opt to use the daily chart since the daily chart is more common than a 16-hour chart. Notice that the daily chart is actually 6 times that of a 4-hour chart. But hey, that's okay as well because as mentioned, the minimum is at least 4 times. So in this case, it is perfectly fine. Now moving on to the second scenario. This one happens rather frequently, and if you haven't been paying attention to this, it is probably costing you a lot of money. So pay close attention and keep watching. The second scenario where you should not be buying at support is when you see bearish build up pressure. Of course, the opposite is true. You should not be selling at resistance when you see bullish build up pressure. So what is this bullish or bearish build up pressure that I'm referring to? In short, I'm referring to an ascending and descending triangle. But let me break it down for you. Now, a bullish pressure happens when you see higher lows going into a resistance level. You should also be able to draw an ascending trend line to connect the lows to form an ascending triangle chart pattern. When you see something like this, you should avoid selling at the resistance level. I mean, think about it. The higher lows signify that bulls are willing to buy at a higher price each time. And why would they do that unless, of course, they expect the resistance to break? So, stay away from selling at resistance when you see this chart pattern. Here's another example, this time a bearish scenario. We have the prominent key support level here, and if we were to observe price carefully, we will see that price has been forming lower highs. In fact, each bounce off the support level grows weaker and weaker. So by connecting the swing highs, we can see a descending triangle chart pattern. So what happens in this case? Look what happens eventually. Well, the bulls were squeezed out of their positions and the price broke out strongly after the key support was broken. If you took a long position, this was a trade that would have been a loss, and it could have been avoided if you understood this concept. So as mentioned at the start of this video, it is possible to reduce the likelihood of buying at a level that won't hold, and that's by watching for a bullish and bearish build-up pressure. Let's move on to the last scenario where you should not buy at support and sell at resistance. This last scenario is when there is a high impact news event around the corner. I will use the word news event and economic data interchangeably, but I'm referring to the same thing. If you are new to trading Forex, then you want to check out the Forex economic calendar to see when the high impact economic data is being released. Over here, you are looking at the forexfactory.com economic calendar. It is free and you can visit the website to retrieve it. The high impact news is denoted by the red icon you see over here. If you prefer, you can also go ahead to filter out the economic data so that you will only see the high impact news. When you see a piece of high impact economic data around the corner, that's when you want to avoid buying at support or selling at resistance. Why? Because price has the potential to whip both ways and trigger your stop loss. And not to add that the spread widens during high impact news events, which can easily trigger your stop loss. Now, not all high impact news is expected to be whippy and trigger your stop loss. Sometimes there are so much economic data being released that you end up missing tons of opportunities if you are too conservative. This is especially true if you pay attention to all economic data releases, such as the low and medium impact news event as well, not just the high impact news event. This is why I recommend avoiding buying at support or selling at resistance whenever there is a high impact news event only. At the start of this video, I promised to reveal to you an event that you want to avoid trading. This event is the non-farm payroll or NFP in short. Of all the events, this is by far the most whippy news event, and this is the event that you definitely want to avoid. And I encourage you to take some time to study the price movement before and after the data is released. You will see that price is mostly stagnant before the data is released anyways. So there's really no point in trying to buy or sell before the news and risk getting whipped out. So let me do a quick recap of the 3 scenarios of when you should avoid buying to support or selling into resistance. Number 1. Higher time frame support and resistance. you want to avoid buying at H4 support if the daily chart is at resistance. Remember that the higher time frame trumps the lower time frame. Number 2, bullish or bearish build up. When you see an ascending triangle or descending triangle, that's not a sign to sell at resistance or buy at support, respectively. Number 3, high impact economic data. When a high impact economic data is about to be released, it is wiser to stay out and not buy at support or sell at resistance. Do remember to avoid trading the non-farm payroll as well. And that's it for this video. If you got value, please hit that subscribe button and turn on the notification bell so you will know when we release a new video. We usually do about 3 videos a week to help you become a better trader. So you definitely want to know when our new video is released. As promised, I will drop the link to the video covering the rule of 4 in greater detail over here. Thanks for watching. I'll see you in the next one.